Contrarian. I'm Harry Long, Managing Partner of Contrarian Industries. In this show, we're going to show you companies which are unloved, undiscovered, and undervalued. The emphasis in this show is going to be on intrinsic value. What are these companies worth to a private business owner, a private equity firm, or a strategic acquirer? We're going to try to be the anti-Kramer. We're not going to throw things at the camera, look at stock charts, or just discuss things qualitatively. We're going to dig deep into the numbers to get a true idea of the performance of the business and what it's worth to a private business person. Please keep in mind, we're not a disinterested party. For every single company that I discuss in these shows, either my firm, Contrarian Industries, owns it, or we own it personally. For investment advice, please consult a registered financial advisor. Today we're looking at SureWest Communications. Now, SureWest is kind of a classic case of a telecom company which is in both traditional telecom in Roseville, California, and also has a broadband segment which does high-speed internet and cable TV over a fiber optic network. And this stock is amazing. It's really hated. If you look back at 2000 here on the graph, and then you look all the way to the present, this stock, in my opinion, is really unjustly biased against. I mean, people really hate this company. And I think when we look at the numbers, we might see that that hate is pretty unjustified. So going into the numbers, we have a $150 million market cap. The big picture here is that in 2000, revenue was $128 million. And in the latest 12 months, $242 million. What's even more interesting is how stable the cash flow is. Back in 2000, it was at $53 million. And in the latest 12 months, running at $66 million on operating cash flow. The other interesting thing to note here is that every year there are huge capital expenditures. So basically, long story short, as I mentioned before, they had a traditional copper telephony network in Roseville, which was the old Roseville Municipal Telephone Company. And they've been basically taking these capital expenditures and building out a fiber network. Now that's already done. The fiber network's in the ground. Nothing is faster than the speed of light. They have a fantastically fast network. And so what my argument is, when I spoke to Steve Oldham, he said to me that capital expenditures, maintenance capital expenditures to maintain the current network were $15 million a year. So if we take this $66 million in operating cash flow and we subtract out $15 million, we then have $51 million in free cash flow if any type of CapEx, which wasn't spent on the network to maintain it, was just cut out. Any kind of growth CapEx, we call it, was cut out. And when you look at the stock, they could probably dividend out $3.20 a share annually. That's my estimate. And as we know, these telecom companies trade on dividend yield, and dividend yields top out usually at 10%, even for a foreign telecom like New Zealand Telecom. So I believe that you could see a $32 share stock price if the company's management could be convinced to pay out such a large dividend. And remember, this is the same CEO who a couple of years ago actually cut the company's dividend. So I think it's unlikely the company would actually agree to institute such a large dividend without pressure from an activist investor or maybe a private equity firm, etc., which would make a hostile bid for the company. So let's go into the financials on a little more of a granular level. When you see a company which is trading for 2.3 times cash flow from operations and about 4.6 times enterprise value to EBITDA, it's usually doing that because people think that revenue is in a perpetual state of decline. Now, as we've seen before, that's quite the opposite with SureWest. Revenue has been growing for 10 years. It's just the capital expenditures are so high and dividends are non-existent right now, and I think that's really hurt shareholder value. But just to put to rest any critics of the company who may say, well, you know, when a company's that cheap, it must have decreasing revenue. Let's look at the latest quarter. You had $59.5 million in revenue for the September 30th quarter 2009. This year had $61.1 million for that same quarter. And looking at it on a little more granular level, as we see right here, broadband revenues are increasing, and that increase is enough to offset the decline in telecom. So essentially revenue is stable to slightly growing, and as time goes on, you're going to see traditional telecom decrease and broadband, high-speed internet, cable TV, etc. increase. So I just wanted to prove to any critics that this is not some business where revenue is declining at double digits, where it would deserve to have such a low valuation in relation to its cash flow. Moving on, we can see the same trend in a larger sense from 2007 to 2009. Broadband was only 39% of revenue in 2007, and now it's in 2009 it's 67% of revenue. So we see the same trend there where declines in traditional telecom are being offset in the revenue mix by the broadband, which is fantastic. The other thing sometimes you want to look at is adjusted EBITDA, and that's increased from $57.2 million in 2007 to $77.8 million in 2009. That's fantastic. So the really big picture here is you have fantastic cash flow. You have a very, very stable telecom business. I mean, next to electric utilities, telecom companies are the most stable thing out there, and they don't have a lot of the environmental liabilities that an electric utility often does. And it's trading for an extremely low valuation. Now, the company does have $200 million of debt on the balance sheet, but the big picture is that that kind of debt, bankers love to extend credit, and bond markets love to extend credit to such a stable revenue and cash flow business. So right now, if you look at the market as a whole, really high-quality credits are not borrowing. And so I think this company would be a fantastic target for a leveraged buyout by a private equity firm or another acquirer. So to really unlock value with this company, an activist investor would have to get involved. They either need to pressure the company to institute a dividend or sell off to a Comcast, or a private equity firm would have to do a leveraged buyout. Those would be the three catalysts. I'm not sure that this stock is right for retail investors, but I think for an institution with the wherewithal to stick with it and to press for effective change, I think it could be a very interesting investment. On the Contrarian, our main message is that cheap is no longer good enough. Cheapness and valuation has to be paired with amazing business stability in the form of revenue and cash flow stability. SureWest, as we've seen, meets both of these criterion, but even with those two criterion, it's not enough for the stock to rise. We need an activist investor to become involved in the company who will either wage a proxy contest or throw out the chief executive officer, who it seems so far has not been amenable to instituting a dividend. So what we really need would be an activist investor become involved in the company, for the company to declare a dividend, or for the company to be taken over by a larger acquirer. In my opinion, without any of these three catalysts, it's really tough for the stock price to rise from here. But if any of these three catalysts occur, the stock could be worth much more than it's currently trading for. Thanks for watching.